Welcome back to our Citizens Monetary Policy Committee meeting. This committee meets on the eve of the monetary policy before every policy to recommend to the Reserve Bank the action that they think is appropriate. I have with me Sajid Chinoy, Soumyakanti Ghosh, Samiran Chakraborty, Sonal Verma and Dr. Pranab Sen on the chair. Well, we need to, discuss the liquidity situation a little more. Sajid, the Reserve Bank has pumped in 80,000 crores, almost at an average pace of 20,000 crores every month. Do you think that it should continue with this pace, or do you think it is in danger of over-loosening?
Yeah. So I think the new liquidity framework essentially says that durable outflows will be matched by durable inflows. And they've kept up to their word. Whatever currency in circulation outflows have been seen, you've seen OMOs offset that. Over the next 4 or 5 months, starting September, currency in circulation typically increases by close to 100,000 crore between September and December, which means, if you continue with the same framework, you'll see 25,000 crore or so of OMOs every month in keeping with their current momentum. I guess the question is, why are we doing this? And the initial thinking was, well, because this is impeding monetary transmission. Banks aren't cutting deposit rates because liquidity is too tight. If they can't cut deposit rates, they won't cut lending rates. The jury is still out, but 3 months into the new liquidity framework, there's very little to suggest that the transmission in wholesale market rates and easier liquidity conditions is having any salutary impact on bank rates. There are various factors at play. Soumya mentioned FCNR. I would argue there are more fundamental issues that until you solve the NPA problem, banks will be less inclined to grow their balance sheets. So I'll just make one final point, which is that if in fact you continue to find that easier liquidity conditions are not creating this transmission, we may run the risk that if the inflation cycle turns, what you don't want is at some point to honor these liquidity requirements is your base money growth outstripping what would have been appropriate to support find inflation levels, right? So you don't want the system to be over-determined where you have an inflation target, but you also have a liquidity target, and you may find that these are internally inconsistent. That's my only concern. We're not there now. It's a concern I harbor for the next 6 to 12 months.
Sonal reminded us of this potential problem in the last meeting as well. Sonal, the Reserve Bank can always start selling bonds if it reached a situation where liquidity is too good and inflation is actually becoming a problem. But at the moment, they seem to have developed a very good marksmanship on maneuvering the overnight rate. Sonal, what I wanted to ask you is that is the Reserve Bank now required to do something more on NPA? Or do you think this pressure of lower yields have gone down to 7.1? Now, if most of the corporates start borrowing from there, market will cast its pressure on the banks, you think? So is the Reserve Bank just to leave the liquidity and the rate situation as it is? Or does it need to do something more to ensure transmission from the banks?
One of the things that was highlighted in the last policy was a sort of a review of the MCLR mechanism, because when we moved from the base rate to the MCLR mechanism, there was an assumption that transmission would be much better. It's been marginally better, but not significantly better. So, even within the MCLR, there seems to be areas where banks actually have discretion, which is actually partly impeding transmission, which is more on the technical side. I think the Reserve Bank is probably going to shed more light on this, either in this policy or maybe the October policy, but clearly that is required. On the liquidity front, I think they have actually, I agree with Sajid, they have done a fabulous job in terms of bringing down system liquidity, now almost close to zero in our view. Post-September is when the challenge will start, when the currency outflows continue, and they will require to do a substantial amount of open market operations. Well, whether they need to do bond sales or not also depends on the outlook on foreign capital.
Yes.
If you do see a substantial amount of inflows, then yes, but remember, September to November is a period where we will see FCNRB outflows. Even the Reserve Bank expects almost $20 billion worth of outflows. So there is going to be some, liquidity tightness, not just because of the currency outflow, but also potentially because of additional dollar selling that the RBI might have to do during that period. Therefore, from an OMO perspective, I think the chances of sales look low right now. It looks more like it is going to be bond buying at this stage. And finally, on NPAs and transmission, I mean, I agree that partly NPAs are an issue, and to that are an issue in terms of impeding transmission, and to the extent that the treasury profits that banks make now because of yields coming down, they might be more open to sort of narrowing the the lending deposit spread, which has widened because banks have been trying to offset the NPL losses by keeping the lending deposit spread quite high. So to the extent that treasury profits are coming in, banks might be more open to actually passing on cuts going forward. But remember that also banks had garnered a lot of high cost deposits in 2013. Some of these were 3-year plus deposits, fixed deposits. So we are now coming into a period where actually a lot of these deposits will come up for redemption, and therefore actually the costs of the banking system will come down. So if we do get a review of the MCLR mechanism, treasury profits are happening right now, and deposit costs come down, then I think we should see more transmission. There isn't much that the Reserve Bank actually needs to do at this stage.
Okay, well, you'll have to be a little quick in what is your assessment of liquidity. Is it best left alone? Are they doing a good job? But the more important point, do you want the Reserve Bank to do anything on the banking front to ensure transmission?
Well, I think the liquidity part is doing quite well. There would be some challenges after September, but that's okay. We have found out the way to manage it. I think the bigger question is with the NPA situation that we have done a little bit of a simulation exercise which shows that for the stressed asset ratio to come down to 7%, which is like the 2004 level, it will take 3 to 5 years if the credit growth is between 11 to 14% and stressed assets do not increase any farther from the current levels. So are we then talking about challenged monetary policy transmission mechanism for 3 to 5 years because of this NPA problem? So that's why I think that they have to focus on NPA resolution as a separate objective apart from the normal monetary policy transmission issue. And I think that's going to be quite important.
Okay. Shaumya, what's your sense? You would be best placed as a banker yourself, the largest commercial banker. Do you think the pressure from the market is enough to bring rates down? Or would you recommend that the Reserve Bank do something more on the NPA or any other front?
No, I'll tell you one thing. I think we had a lot of discussion about the MCLR, but if you look into the MCLR calculation, which is now completely formula based, 67 to 70% is driven by the cost of deposits. So I think that's the most important factor, and banks need to pare their deposit rates downward so as to do for an MCLR effective transmission, which I think is not happening right now because of the fear of possible outflows in September to November because of the FCNR. So that's the first most important thing. The other thing, I think, as the period grows by, and if you had looked into, as Saminana was saying, if you had looked into the other cycles, for example, in 1998, we were sitting on a GNPA ratio of 16%, which was brought down to 5% over 2006. But we had the fortune of our global growth at that point. Right now, we don't have the growth, so the best way to go forward is to go for the resolution of the assets quickly. But that's easier said than done because the banks have been grappling for the resolution for the last couple of years. There has been not been coming through because of the plethora of issues. Hopefully that will now take off because of the new resolution mechanism, the NPA, and also the fact that, for example, our bank has got into a tie-up with some of this. So that, I think more of that things will happen in the near future. And if that doesn't happen, I think the transmission will continue to happen, but that will not happen at the pace which, for example, all of us would want us to happen.
Okay. Well, my own sense is the MCLR has come down by about 10 basis points across banks, 15 in some. But deposit rates, to take an average, has gone down by about at least 50 basis points. Dr. Sen, would you think that the pressure from the market with yields falling from 7.4 to 7.1 is enough? Or do you think the Reserve Bank has to do something more proactive to prod the banks to cut, probably change the MCLR formula, or maybe be more proactive in NPA, moral suasion? Does it have to do something in terms of cutting, in terms of forcing banks to cut rates?
Well, you really have to be a little careful on this. The banks are today running the lowest rate of growth on the credit side than they've done in probably a few decades. And so you're in a situation where the banks are under pressure anyway because their, to call it turnover if you will, is growing slowly. Now, is this the time when you want them to cut their margins? In fact, the best time to cut margins is when the turnover is growing rapidly. And so if you're thinking about the welfare of the banks, and that's something which we need to keep in mind now because of the pressures they are, because of the NPA problem, I wouldn't get overly sort of critical of the banks not lowering the rates too fast.
In that case, Dr. Sen, as the chairman, what would, before I take a vote from the members, what would be your non-rate action recommendations to the Reserve Bank?
On the rate, we are coming into a season where there is a tendency for prices to go up. My recommendation would be keep the rate where it is, slow down the liquidity increase for a little while. From the roughly the 20,000 crores that's been pumped in on a monthly basis, perhaps bring it down a little bit, and start thinking about the timing at which you start relaxing all the taps simultaneously.
Okay. Well, we've heard the chairman and the committee members on their assessment of growth, liquidity and inflation, as well as their fears of how things might happen in the coming months. Lady and gentlemen, it's time to take a vote. The chairman will vote last because he has the right of a casting vote. So let's start with the members. Please write out your vote on the placards given to you, and we can start the process of you all declaring what you would like. Sonal Verma, what would be your recommendation to the Reserve Bank in terms of rate action? Okay, that's a no change from Sonal Verma. Sajid, your recommendation? That's a no change yet again. Shaumyo, what would be yours? Okay, that's no change. 3 people say no change. So the chairman's casting vote will not be needed. But what's Shaumiran's recommendation? Oh, it's no change. It's for no change. Dr. Sen, your word, I thought we got it when you were speaking, but what's your word on rate action? Well, in that case, the unanimous vote of the committee is that there will be no change. There should be no change in rates, so not recommending a rate cut. But there are important recommendations on liquidity. The members, Sajid, Samiran, Shaumyo, did want Reserve Bank to continue with the liquidity operations because that has effectively meant a quarter percentage or even more in terms of a fall in yields. Dr. Sen warns that further liquidity action should be very carefully thought out because there could be a lot of sucking out of liquidity and therefore inflationary pressures. On NPA, of course, the members wanted the Reserve Bank to continue with their action, but Dr. Sen again warns that the health of the banks needs to be kept in mind. That's the recommendation from this committee to the Reserve Bank. Thank you very much for watching this edition of the important meeting of the Citizens Monetary Policy Committee ahead of the Reserve Bank's monetary policy.